As part of celebrations marking 30 years of democracy, the Trade and Industry Department is hosting a worker share ownership conference at the Sandton Convention Centre. The gathering is focusing on the impact of worker ownership schemes and their funding. Earlier on, our economics editor Tshepo Mongwae spoke to Lucretia Khumalo from the IDC about the risks of participating in employee share schemes.
We're still here at the Sandton Convention Centre where we are attending the Employee Share Ownership Conference, where various companies are here to talk about how they've structured their deals and how those deals are actually benefiting the workers. We were told that 3 billion rand in dividends were paid to employees through this Employee Share Ownership Scheme, and of course, average beneficiary receiving just over 12,000 rand annually in dividends. For more on this, we are now joined by Lucretia Khumalo. She's with the IDC, just to get a little bit sense of how these deals are structured. We were told 12,000 rand, just over 12,000 rand in beneficiaries accruing to workers. Is that really enough, or does it speak to how these deals are structured?
Thank you very much, Tshepo, and good afternoon to all the listeners and those that are watching from home. The transactions are typically structured in many different ways. So sometimes you may find that a company does vendor financing, so they fund the transactions themselves. Sometimes they raise funding from the market, so they basically get loans to buy these shares on behalf of the employees. And of course, depending on how the transaction is, and then the third option is that sometimes the shares are really just bequeathed or given for free to the employees. So depending on the structure that is followed and depending on how the company performs, the employees can benefit or not benefit from these structures. So the way that you fund these transactions, the way that the company then performs after the transaction is closed, and also how much you paid for the shares. If you overpay for the shares, they are unlikely to benefit the employees. So that's what we see. Your other question is it enough? Certainly it's not enough. We would like to see more. We would like to see employees benefiting more from the companies that they work for, because they are very important stakeholders from many different angles for an organization.
I mean, there's a push for workers to benefit from day one in a form of a dividend, so that not all the amount is actually goes towards financing the loan. Is that a viable option?
It is viable, but remember what I said, how a share ownership scheme performs depends on the health of the company itself. So it is viable, and we are doing that. We're starting to design what we call trickle dividends, but that's only viable if the company is doing well, because a trickle dividend can only be declared if the company is actually declaring a dividend to other shareholders. So where that dividend would have primarily gone to paying for finance costs, we then ensure that a portion of that dividend goes to the employees and they begin to benefit. But where a company is struggling, even that design doesn't work, because if a company is struggling, then it will not be declaring dividends, and therefore none of the shareholders, including the employees, will benefit financially. That's why I said these employee workers schemes are important for a number of different reasons. Financial benefits is just one way. What we are looking for is that the employees become really committed to the organization. They drive the performance and ensure that the company itself is in a healthy state and is able to declare dividends to all the shareholders, including the employees.
Is it possible that these deals can be structured in a way that whether the company performs or not, workers still get some value?
It is possible, but it is difficult, because we are looking at workers as part of the shareholding of the organization. So it is possible to design some type of a trickle dividend from the profits of the company, but that really becomes a special award that the company and its board then agrees to make available. But this is only possible if the company is healthy. If the company is struggling and it's really just making enough money to pay its costs and salaries and costs such as those, it would be very difficult to then declare dividends to their employees. But what's also very key is that the employees themselves also need to understand that they are actually shareholders of the company. So they need to understand that their role is much bigger in terms of ensuring that strategically the company is able to perform. Because when the company performs, they will benefit greatly.
What were the common mistake, or I should say maybe features that actually in the previous deals made them to go underwater?
Like I said earlier, if a valuation was too high, so some of the transactions, and we see them also with BEE transactions, where the valuation was too high at the time when the transaction was concluded, and that share price maybe goes down immediately thereafter, and the dividend that comes in is supposed to settle the funding that was raised. Obviously, that means that there will not be any dividends that accrue to the employees. The funding methods that are used, if the funds were raised from funders such as banks and even ourselves, and there wasn't a design of a trickle dividend, even if that company declares a dividend, that dividend will first go to paying for the financing costs before it comes to the employees. And in a lot of those structures, the financing costs had to be paid in full before the employees benefit in any way. So you do find that, and those are really were serious mistakes, because the employees would be seeing that other shareholders are getting dividends, but they themselves as shareholders are getting nothing. And it's really because of that, the design of that funding. And then lastly, in the past, there wasn't enough communication, governance, involvement of these employees in the governing structure of the organizations, so that they can understand what are some of the issues that are being faced by the organization. So when we start to fix those things and we involve them more in the discussions, we start seeing improvements in these kind of transactions.
Thank you very much for speaking to us. That's Lucretia Kumalo from the IDC. And of course, the very important point that she's raising is that there are a lot of uncertainties in terms of how these deals can eventually be beneficial to the workers. And there's a high possibility also that some of these deals, depending on how the company is performing, might not yield positive results for the workers. On that note, is back to studio.